and welcome to Market Domination. I'm Brooke DiPalma in for Josh Lipton live from our New York headquarters. There's about 30 minutes until the closing bell. Let's get a quick check on the latest market action because we're seeing all three major indices in the red, mostly flat, holding steady to end today's trading session of the shortened week. We have the Dow holding on to some downward momentum, down about 0.1%. The NASDAQ also dragged lower, down about 0.1% as well, after some optimism around the AI trade really boosted momentum earlier today's trading session. And the S&P 500 mostly steady, mostly flat throughout today's trading session, especially as we make our way towards the close. But I do want to take a look over the past 5 days because all eyes are on that Santa Claus rally. Over the past 5 days, the S&P 500 up about 0.4%. We're looking for a 1.3% gain over the last 5 trading sessions in the first 2 of the 2026 trading year to really see that Santa Claus rally come to fruition, often a positive indicator for what 2026 could hold out. So all eyes on the S&P 500. I do want to take a look at some commodities because right now we are seeing gold see a bit of a reversal after a bit of sell-off on Monday's trading session. Silver saw its largest day drop in the past 5 years on Monday, now seeing some renewed momentum as well. And copper also seeing momentum. Taking a quick look at the NASDAQ as well, mostly a mixed picture here, but Meta, Intel moving higher. Meta after that $2 billion deal to acquire Chinese AI startup Manus. Also Intel moving higher after we got Nvidia really taking on that $5 billion stake in the company. Intel moving higher, up about 2% today. But we also did get some key data from the Federal Reserve. The Federal Reserve just released the minutes from its December meeting, showing a tight split over the latest rate cut. Yahoo Finance senior Fed correspondent Jennifer Schonberger joins us now with the details. Jen?
Hey there, Brooke. That's right. Cutting rates in December was a close call for some on the Federal Reserve, while some think it will be some time before they cut rates again, according to minutes from the December policy meeting that were released this afternoon. Those minutes read, quote, most participants judged that further downward adjustments to the target range for the Fed funds rate would likely be appropriate if inflation declined over time as expected. With respect to the extent and timing of additional adjustments to the target range for the Fed funds rate, some participants suggested that under their economic outlook, it would likely be appropriate to keep the target range unchanged for some time after a lowering of the range at this meeting. Now, when it came to cutting rates this month, officials were split. While most officials did favor cutting rates because of concerns about the job market, there were some who favored holding interest rates steady because they are concerned that inflation has stalled here. Now, there were some who did vote in favor of cutting rates, but could have voted in favor of keeping rates unchanged because they thought we're going to get a bunch of new data post-meeting that will better inform our decision about whether we need to cut rates again. And still, there were a few, some of which we know, including Kansas City Fed President Jeff Schmidt, who thought a rate cut was not justified because there wasn't significant deterioration in the job market. Now, looking ahead to next year, as far as the outlook for inflation and the job market, Fed officials still believe that inflation will remain, quote, somewhat elevated in the near term. They do think, however, that any upward pressure from tariffs on inflation will begin to subside, though the extent and timing of that remains uncertain. And there is a concern that perhaps the upward pressure and tariffs on costs for businesses could still be passed on to consumers. So they're keeping an eye on that. Now, when it comes to the job market, they think that that will stabilize next year, though the outlook is uncertain because we have had a delay with official government data due to the shutdown. Still, many see downside risks to the job market. Bottom line here, Brooke, these minutes signaling that the Fed is not likely to cut rates again anytime soon.
Now, Jen, to add to all of this, President Trump is also threatening to sue Fed Chair Jerome Powell and saying that he would, quote, love to fire him. I mean, how much of a risk is this for the Fed in 2026?
Yeah, I mean, look, I would never put it past the president to do something on this front, right? It's always on the table. But these comments that you referenced, which the president made late yesterday afternoon, he also said in the same sentence that Look, it is kind of close to the time with which I'm going to be nominating the next chair of the Federal Reserve, so maybe I won't do it, maybe I will. He left the question mark up in the air. But by the time he does announce that nominee and that nominee goes through the confirmation process, it's just about time for that person to take the helm. So it may not be worth it for the president to do that. If he were to bring a lawsuit, I would expect that it would escalate to the Supreme Court. Something that we have seen with Fed Governor Lisa Cook, a case that the High Court is going to hear next month in January. So it's possible, but I don't think it's probable.
A lot of wait and see, Jen. Jennifer Schonberger, thanks so much for joining us.
Thank you.
While markets are limping into the new year, stocks are little changed on low volume, but 2025 has been one for the record books. And my next guest sees more room to run. Joining me now is Ross Mayfield. He's Baird investment strategist. Let's start with what we've been seeing over the past few days, because we saw that tech slide on Monday. Now we're seeing markets mostly hold steady. Why are you so optimistic about what 2026 could hold?
In part because of that, this has been a market where the AI trade has kind of slowed down a little bit, and the broad indexes have still held up well. This has been a rotational market where things like consumer discretionary and financials have kind of picked up some slack. So I think it's really reassuring that the broad market, in the US and globally, doesn't need tech to be firing on all cylinders to continue the bull market. So heading into 2026, we've got a lot of stimulus coming, rate cuts, as was mentioned, fiscal stimulus, and we've got strong profit momentum as well, which has driven indexes higher this year. So there's a lot to like. And if there's a risk, it's just that. It's sentiment. It's that everybody sees a lot to like, and that can be the thing that tips markets sometimes.
But Ross, you still do expect some volatility in the first quarter of 2026. So how should investors be planning ahead of that?
Yeah, so I think we're in the middle of a cyclical bull market. Started in October of 2022. Your average bull market is 5 years. I think this one has plenty of room to run. So when we get these pockets of weakness in a bull market like this, and especially, if it's just volatility related to some headlines or some profit taking, I think it's buyable. Every pullback, in this cycle has been very buyable, and you've needed to move quickly. Even the big sell-off in April, you only had a couple of days to get a buy-in before the market rebounded. So we've gotten used to these V-shaped rebounds when the market sells off, and I think there's more of that to come. So volatility would be buyable in 2026 is how we're going into the year.
Ross, one of the key concerns among investors right now is that AI bubble risk, that valuations are just too high right now. What's your message for investors who are a bit nervous, especially heading into this next year where AI is really going to ramp up?
Yeah, absolutely. I mean, valuations are stretched, that's for sure. That's why we're counting on profits to kind of carry the baton in 2026. And I think they'll do so. Valuation, as has been repeated ad nauseum, is not a good timing tool for the market. So, markets can stay expensive for a long period of time. As for the bubble conversation, especially if we're comparing it to the dot-com bubble of the late 90s, this has been a nice bull market, strong returns, but nothing comparable to the parabolic price move seen in the late 90s and the euphoric sentiment, right? Where every bear was throwing in the towel. You had IPOs coming every day, doubling on their opens. So I think we're in a tech-driven bull market, but I don't think we're even close to the bubble comp of the late 90s. We have plenty of room to run before we get there. And I hope we do, because a lot of money was made in the late 90s before things went bust.
All right, so Ross, you expect this bull market to continue. Do you buy international as well to sort of position yourself?
Yeah, absolutely. I'm very pro international. I think, anecdotally, just talking to our clients, I think a lot of U.S. investors have thrown in the towel after a really difficult 15 years post-financial crisis. But international meaningfully outperformed this year. The dollar has weakened, and I think that's a trend that likely continues, which is a huge boon to international stocks. You've got some real catalysts, right, with the European, fiscal spending, regulatory reform and shareholder reform in Japan. So there's a lot to like internationally. I think, particularly just to get to market weight, I think a lot of U.S. investors would have to buy, because I think they've thrown in the towel over the last decade and a half. So I'm pro international. I like that trade heading into 2026, and I think it, quite frankly, is a nice barbell with U.S. stocks that are so tech heavy. International offers a bit more flavor.
Ross, at the top, you also mentioned that you like financials, you like discretionary moving into 2026. Why are those sectors attractive to you right now?
Yeah, I think the economy is in good shape. Rates are coming down. We want to own cyclical stocks that are exposed to the real economy. On the discretionary front, I think the worries about the consumer are a bit overblown. I mean, obviously we're keeping our eye on the labor market, but the underlying trend is still solid. Spending was good. It was a nice holiday season by and large. And then on the financials, kind of the same idea. Real economy stocks, cyclicals. The banks have done quite well. I think 2026 is shaping up to be a year with a lot of deal making, some big IPOs in the pipeline, and obviously a good stock market, kind of rising tide that lifts all boats in the wealth management space. So I like those cyclical sectors. I would lean large cap and high quality. I wouldn't want to take too much risk at this stage of a bull market, but I think there's enough to like in those kind of rate sensitive cyclicals that I would be adding here.
Ross Mayfield of Baird, thank you so much for joining us and have a happy new year.
Same to you. Thanks.
Oracle has had quite the eventful year. The stock is headed for gains after trading in a wide range in 2025. But as investors grapple with this ambitious pivot to cloud and AI infrastructure, risk concerns have crept in. The stock is down roughly 30% so far this quarter, and it's headed for its steepest drop since the third quarter of, get this, 2001. And with a whole new year of AI on the horizon, we're laying out what's ahead for Oracle with Ali Melli, Mona Chill Capital Partners managing partner and CIO. Ali, I want to start here with Oracle's partnership with OpenAI, because one BNP Paribas analyst told Yahoo Finance that OpenAI's potential inability to pay for its AI infrastructure could be one of Oracle's biggest risks. We've seen this recent sell-off. What do you make of that? Is OpenAI's inability or ability to pay a major risk to Oracle moving forward?
It is indeed a major risk, and thank you very much for having me. I do believe it's a major risk. OpenAI, according to Microsoft's financial statements, is losing around $12 billion a quarter, and their financial disclosures are not very transparent. And as Oracle's largest customer, essentially they could be a source of risk. One of the biggest component of CapEx that Oracle has is building data centers for that are contracted with OpenAI. And an open question would be, in case there is a failure to pay by OpenAI, how can those data centers be repurposed?
Ali, how do investors assess this long-term potential of AI while also taking into consideration the risks on their near-term balance sheet?
I do think that looking at balance sheets actually is a good place to start. If you look at Oracle on the surface, the financial statements show significant growth in the earnings. But if you look at the details of those earnings, the earning growth was come from a non-recurring item, which was a sale of a venture that they had with SoftBank. And that contributed roughly $2.5 billion to their earnings. If you take that out, Oracle is essentially operating income is growing at a fairly respectable 12 to 15%, which is, again, very good number in and of itself, but it is not the explosive growth that would justify equity valuation to move higher. And another factor that is impacting equity, and that's really like where my interest in Oracle is on the credit side. If you look at credit spreads, Oracle's credit spreads are moving wider and wider because their CapEx has gone from $6 billion over the prior 6 months period to $20 billion. And that's a significant growth in CapEx that is being funded by credit.
There are some key concerns around not just Oracle, but other even smaller AI players here like CoreWeave, some credit risk concerns. How do concerns over a company like CoreWeave sort of trickle into Oracle's and investors' concern there, but also the other larger, broader AI trade that has really led this stock market rally over 2025?
Sure. At the end of the day, Oracle, I think of it as a relatively safe company when it comes to credit. They have their software business. Other than OpenAI, if you look at their other major customers, they are Microsoft, there is NVIDIA, there is ByteDance, and then you always have Mr. Larry Ellison, who is a genius. So on one hand, Oracle is I think of it as on the safer side of the credit play. But as you mentioned, CoreWeave and CoreWeave's business model is under threat. And I think some of the movement that we are seeing in Oracle's credit spread and cost of capital is more really because CoreWeave CDS is so expensive that investors that have exposure to data centers, rather than trying to hedge by CoreWeave, and you have to pay a lot to hedge CoreWeave's credit risk because they are a high yield company, they come and use Oracle shorts as a proxy for AI credit risk. And I do not necessarily believe that that's the best proxy for AI credit risk. And at the same time, as you are pointing it out correctly, like some of the concerns that people have in CoreWeave, because they cannot express it by shorting CoreWeave, because you have to pay a lot of money to short CoreWeave, they are just using Oracle as a cheap proxy.
And now, Ali, you mentioned it at the top of that, but now TikTok is something that Oracle has its hands on, especially particularly here in the U.S. operations. ByteDance, the parent company there. Investors hearing this, maybe for the first time, thinking Oracle is going to be part of a group of investors who own TikTok here in the U.S. How do you make that? How do you make way of that? Should this eventually come to fruition?
We think that anyway, Oracle and ByteDance have a relationship that has been going on for a few years, where Oracle has been providing their cloud services to ByteDance's U.S. operations, and that partnership has been growing. I do think that the joint venture, and it's important to note that this is not a merger per se, it's more a joint venture of which Oracle is a shareholder, is going to bring a very stable kind of essentially customer of their AI services back to them. So to some extent, that balances out the risk that Oracle has to OpenAI, where if you have an OpenAI credit event, you probably that's going to be offset by the fact that you have other stable customers like ByteDance. And then in the event that ByteDance becomes a major revenue source, that could also further reduce credit risk and possibly be a source of profitability for Oracle.
So we all have to buckle up and see how 2026 holds out for Oracle. Ali Melli, thank you so much for joining us.
Thank you very much for having me. It was fun.
Coming up, we're blasting off into 2026 with a look at space stocks. One analyst will break down what you should be thinking about. That's next on Market Domination. The space trade is entering a new phase. It's not just about rockets and launches anymore. It's about data, connectivity, and infrastructure that can generate repeatable revenue. We're navigating how to play the space sector with the Yahoo Finance playbook. And joining me now is Greg Pendy of Disruptive Technology Equity Research, Director there at Clear Street. Thank you so much for joining us.
Thanks for having me.
First, let's sort of start out. We've been hearing the buzzword AI all year long, and you say that there's actually a use case within space, and you have one pick on that. Can you break down?
Absolutely. So when you think of AI, what makes AI really great is good content and good data feeding the AI machines, a large language model. So within that space, we like Planet Labs. It's ticker PL. It trades on the New York Stock Exchange. And what's unique about Planet Labs is they have these Dove satellites right now that map the entire Earth every single day. So we're talking terabytes of data, hundreds of thousands of images. And they've been doing this for 8+ years. However, it's AI that's really unlocking the value in that database, because now you don't have to rely on humans to go through all of that data. You can actually use AI analysis to get instant insights, to find patterns and trends and anomalies going on within the entire Earth.
And so now that's one of your themes. Now the next theme that you have actually has to do with your phone. And when you are in a subway or something and you see that satellite pop up, most people probably don't realize that there's actually a company behind that. It's called Globalstar. So break down that use case.
Absolutely. So we've all have cell phones on us now 24/7, but we've still, since the late 90s when cell phones took off, depend on a cell tower here, a terrestrial cell tower. And that can be challenging in remote areas. Obviously, the ocean is just a no-go. And it's just uneconomical for them to continue to put cell towers in areas, certain areas. However, when you think about space, that can bridge that gap, and it can give you global connectivity. So it's satellites that can be the handoff signal so that you are now going to hopefully be connected at all times. When we look at Globalstar, they're working right now with Apple. And essentially, if you have an Apple iPhone 14 or higher, you can now receive text and SMS messages. And they're also looking to build out a new constellation with Apple, which will be a few years out, which will have increased functionality.
So more room to run in that stock. I believe it's up over 100%. Another use case here is with Intuitive Machines. Now, it is down year to date, but you recently raised your price target on the stock. That price target is now $25. Walk us through what that company does and how that sort of plays into this different take on the space trade.
Absolutely. So now we're going to the moon.
Okay, we're at the moon now, Greg.
Yeah. So with Intuitive Machines, there were a couple things that really got us to raise our price target. First of all, they are doing an accretive acquisition to get into satellite manufacturing, and we're very positive on that deal. But importantly, I would note that in mid-December, Trump put out a space agenda, and it should also be known that Jared Isaacman was appointed the administrator of NASA, and he's a big proponent for space exploration in our view. And that agenda has not only returning humans to the moon in 2028, but also an objective for a permanent presence on the moon by 2030. And that plays right into Intuitive Machines because they have some big projects that they are working on. One will be the NASA Near Space Network, which will, in mid-2026, they plan on sending their first of 5 satellites to the moon to help create a constellation for communication reasons and GPS. And then in addition, a catalyst to watch, we think in early next year, will be the Lunar Terrain Vehicle contract, which they are one of 3 players bidding for.
Now, Greg, super quickly, SpaceX rumored to go public next year. What does that make for the entire space trade?
I think a lot more investors are becoming aware of what's going on in low Earth orbit. It's just drawing a lot of attention on how low Earth orbit can change our lives here on Earth, whether it be through the Earth observation data or the connectivity data.
Greg Pendy, thank you so much for joining us. I appreciate your time and so much to look out for within this trade. So we'll definitely keep an eye on it. Thank you so much. Now time to start some of today's trending tickers, starting with NVIDIA. The chip maker is reportedly in advanced talks to buy Israel-based AI startup AI-21 Labs. Now, according to Calculus Financial Daily, NVIDIA has its sights set on buying the startup for as much as $3 billion. NVIDIA has previously been linked to the company when it participated alongside Alphabet, that's parent company of Google, in a 2023 funding round for AI-21 that valued the company at $1.4 billion. Turning to Under Armour, that stock seeing a pop as Fairfax Financial lifts its stake in the company. According to an SEC filing, Fairfax now owns shares of Under Armour that raises its stake to 16.1% from the previous stake of 9%. This move comes as the company recently reported better than feared second quarter results. Fairfax is also not expected to launch a proxy fight as the firm is considered a long-term investor. And lastly, Trump Media shares are under pressure after the launch of the first 5 Truth Social ETFs. The ETFs are part of the Truth.fi, a fintech brand from Trump Media. The new ETFs include security and defense, energy security, and red state REITs. Yorkville America Equities and Trump Media are also planning to launch additional ETFs in 2026, including equity-based ETFs as well as digital asset-based funds. And coming up, we're wrapping up today's market domination. Don't go anywhere. We got you covered with all the action following the closing bell on the market. Market domination coming up next. Hello and welcome to Market Domination Overtime. Stocks closing the day lower. Our very own Inez Ferre joins us now with the latest. Inez, what are you watching?
Brooke, as you just mentioned, the three major averages down for the day, the third session in a row where we are seeing stocks lower, slightly lower. I mean, you're looking at the Dow that's down 0.1%, the NASDAQ down about 0.2%, but at the lows of the session. And then the S&P 500 also ending lower, down 0.1%. The Russell 2000 small caps, that's also lower 0.6% after the Fed minutes came out today, showing that the participants were divided on the December rate cut, and further cuts will depend on whether inflation comes down or not. Then just taking a look at the 10-year Treasury yield, that's at 4.13%, and the U.S. dollar hovering above 98. Looking under the hood at equities, we are seeing on the NASDAQ 100 a little bit of a mixed picture. This you're looking at Meta up more than 1% after announcing the acquisition of Manus AI, and also looking at the rest of the Mag 7 stocks, a little bit of a mixed picture there, with Tesla down 1% at the lows of the session. Nvidia also lower as well as Apple. You've got Alphabet and Microsoft relatively flat for the session. Looking also at the crypto stocks and cryptocurrencies, Bitcoin up 0.8%, hovering just below 88,000. A good day today for Bitcoin, relatively, given the past couple of weeks and what we've seen with trading. And Ethereum, ETH, up almost at 3,000 per token. And just want to mention what we've been watching with commodities, which we've talked about over the last several weeks and over the last several sessions. We did see today gold up about 4,360 per troy ounce, and then silver futures. This is where the real movement was at after that big decline that we saw yesterday with silver futures declining the most in one day since 2021. Well, today we saw it jump back, so a rebound. Momentum back into this trade as silver futures gained more than 8%. A supply deficit is what traders are talking about when it comes to silver, and also with respect to the onshoring initiatives in the U.S., the AI boom. So that's really what has been in focus over the last several months, really, when it comes to the silver trade. And if we take a look at a year to date, still up 160%, one of the best metals, really, when it comes to the metal rally that we've seen. Brooke?
Quite the month, or quite the year, rather, for all these precious metals. And Inez Ferre, thank you so much for the breakdown.
Thank you.
2025 is nearly at its end, and before we jump into the new year, we're reflecting on the key themes over the past year to help set the stage for 2026. Here with me to talk through it all is Bank of America Institute economist Taylor Boley. Taylor, I want to kick things off with this economic resilience as one of the key themes that you guys highlighted in your report. We saw consumers pull back on their spending in April and May, bounce back in June and July. Were you guys surprised by that? And what does this sort of mean about where consumers are right now?
I think if we take a step back and think of where we were this time last year, we were kind of entering the year in a sort of tepid environment. So when we saw spending get off to a rocky start, is it totally surprising? Not so much. What I think has been surprising has been what we've seen in terms of a bifurcation between higher income and lower income spending, particularly around August. So what that means is really we're seeing spending growth of higher income households really start to grow, whereas lower income households, it's starting to lag a bit. And that's really a wage growth story and really hints at the underlying tones of what we're seeing in the US labor market.
Yeah, and what we've seen is this high income consumer really buoyed by not only wage growth, but also this stock market rally, this momentum. When you think about how this has gone on, one economist, or one analyst rather, told me that the low-income consumer is starting to come up a little bit. When you think about the new year, what we're seeing towards the end of 2025, can this K-shaped economy continue, or will we see that low-income consumer maybe get some ability to spend again?
Yeah, and I mean, I think that really comes down to the labor market. And what we're seeing in our data is that it's cooling but not collapsing. So wage growth remains positive, which is good. Also within our data, we're able to identify unemployment payments. And even though those are up on a year-over-year basis, it's still relatively low. We're not seeing a collapse. So the issue with the K-shaped recovery is oftentimes it's not sustainable. So it certainly will be something we're watching out for as we turn the page to 2026.
One concern is small businesses' ability to hire right now. And we did see construction and restaurants, small businesses there were able to even provide some wage growth because of the inability to hire. So walk us through that dynamic that played out in 2025.
Yeah, and I mean, small businesses, there's this understanding of, okay, what does Main Street look like versus Wall Street?
Right.
And we have really unique insight because we're looking at nearly 70 million consumer and small business accounts. So we can really understand how small businesses are doing, not just from a profitability standpoint, but also from a hiring standpoint. And small business labor market conditions have not been as strong as they were this time last year. And a lot of that is due to uncertainty, as well as cost pressures, because just like consumers, small businesses are also faced with these increasing costs.
Yeah, let's talk about that, because affordability is expected to be a key hot topic issue, especially moving into the midterm elections. When you look back at 2025, did we eventually get relief when it came to the affordability of not only housing, but everyday essentials that Americans are going to the store for?
I mean, I think what's been really interesting is that if you look at a lot of these prints, like the US GDP print that we just saw around consumption, that on the surface looks good. But to your point, this affordability issue is really weighing on a lot of households. And in fact, in our data, we were able to see that 30% of lower income households were living paycheck to paycheck. So I think this really underscores the extent to which, okay, can paychecks actually keep up with the price of essentials?
And now you can't talk about 2025 without talking about the keyword buzzword, AI. And so when you think about how AI is playing into the roles of everyday Americans moving into 2026, really how it's been at the end of 2025, there's some concerns around the price of electricity, what this can mean for power grids. What's your message to some of your clients there?
Yeah, I mean, I think that really the key with AI, right, is that this is transformation, not necessarily elimination. But innovation can come with a price tag. And we do see within our data that on top of other pressures consumers are facing, utility bills are one of those things that households are facing in terms of price increases. The extent to which that's an AI question, I think, is open to debate. But certainly, to your point, AI is all around us and will continue to be something that is very top of mind for business as we go into 2026.
To take a step back, another concern was rent inflation over the course of 2025, and many consumers, Americans, trying to decide, okay, should I jump into this housing market now or do I continue to rent? What did you guys find there?
Yeah, it's interesting. So renters actually caught a bit of a break in the latest data point that we've seen. Now, I will say, if you look at rent shelter inflation, that still remains up. So what is the mismatch there? One of our theories is that supply has actually loosened a little bit in key areas like the South and the West, where there's a lot of these Sunbelt cities where we saw a lot of domestic migration, people moving out of, say, the Northeast to hotspots like Phoenix, Miami. And so we're actually seeing the rent situation there improve in those cities.
Because there's more apartments?
Exactly, yes, yeah. So that is a positive for renters. Now, we are still seeing in our mortgage payments data, it was up 6% year over year towards the end of this year. So that still means, right, that there's still homeowners that are facing high costs, and also there are a lot of buyers that are still on the sidelines.
Right, and as we move towards 2026, it doesn't seem like there's necessarily a straight answer on which one's better here.
Yeah, I mean, and I think a lot of times, right, that's up to individuals' households' decision. And what we're seeing in our data is that, again, housing affordability is top of mind, as are all of these other issues that surround affordability. But at the end of the day, we're still seeing wage growth remain positive, which is really key to be able to continue to make those spending decisions.
Right, a good indicator moving into 2026?
Absolutely.
Taylor Boley of Bank of America, thank you so much for joining us.
Thank you for having me.
And Tesla is doing something it almost never does. It's previewing its own fourth quarter deliveries release and lowering expectations, signaling a sharper year-over-year decline than many on Wall Street expected. Joining me for more is Yahoo Finance senior autos reporter Pras Subramanian. So Pras, break this all down for us. Why did they decide to release it? And what do you make of the early release?
Well, there's no real reason that we know, right? It's really unusual putting this out. Basically, they did their own Wall Street consensus estimates. They pulled, using different analyst estimates there, and they said that they claim consensus is at 40 423,000 units globally. I forgot the 1,000 there, representing a 15% drop year over year, right? Now that's below Bloomberg's own 445,000 delivery estimate, so it's significantly lower there. For the year, consensus estimate, Tesla says 1.64 million deliveries, an 8% drop compared to a year ago, and a second straight year of declines year over year for Tesla. So, what's going on here? Why would you release these estimates, right? Some people think that they're trying to cushion the blow of a really bad Q4 report. We had the loss of the tax credit affecting sales, and maybe it's worse than we thought. So that's probably what's going on here, maybe. But for the stock, it doesn't matter, right?
Yeah.
Declining sales don't matter. Stock is up, a little bit down today, but up for the year. It's all about AI and robo-taxis.
Yeah, and back in September, we saw the cost of a vehicle jump up because of that expiration of the EV tax credit. More and more people are trying to get their electric vehicles before that tax credit expired. But I do want to sort of pivot here because speaking of Tesla, let's talk about robo-taxis, because you think that 2026 could actually be a big year for one of Tesla's biggest competitors, and that's Google's Waymo. So break down, why is 2026 going to be such a big year?
Starting off anecdotally, right? I was just in Austin, Texas for the holidays, and they are everywhere. Waymos are everywhere, driving people off, picking people up.
People are using them, it's easy.
I must have seen about 100, and I saw one Tesla robotaxi, right?
Oh, wow.
Now that's because
hundreds though. That's unlike what you're seeing here in the Northeast.
Well, not yet, right?
Yeah.
And then they've been in LA. I was in LA this past summer. They're all over LA. So they've really grown in the spots that they're actually operating, which is San Francisco, Phoenix, LA, Austin, and Atlanta, right? They're operating these areas without safety drivers. Completely, there's no one in the car. It's just an empty car driving around. So they're actually doing it, and they're charging for it, right? They're going to in 2026, they're going to expand to Miami, Dallas, Houston, San Antonio, Orlando, with full service expected in the early 2026. And they're testing in Detroit, DC, Philadelphia, Pittsburgh, and St. Louis. Even New York City, London, and Tokyo, they're testing there. We'll see if that happens. But very deeply populated urban areas, that's really tough for, robotaxis. So that's happening. Now, by the numbers, right at the end of this year, Waymo was at 250,000 trips a week, right?
Wow.
They want to do, and 20 million for the entire time they've been operating. They want to do 1 million rides a week now by the end of the year.
That's
and the
huge.
next year. So that's
you think
4
they can
times.
Do it?
I mean, if the deployments go well, now you mentioned, can they do it? That's a good question because they have to increase production of their cars. They're building their EVs with the Jaguar I-Paces and the Zeekr Chinese model. But that costs money, and they don't have Tesla's ability to just crank out cars, right? So that's a potential headwind. Secondly, what about regulations and safety? Sometimes some municipalities don't want to have that. Or you have a big sort of safety issue like Cruise did in San Francisco, and that just knocks them out of the game. So those are some of the headwinds that they're facing. But that aside, 2026 could be a big year for them.
Yeah, and you did mention in your story that's now on Yahoo Finance's site that Tesla operates its ride-hailing service with safety occupants still, and they're only in Austin and San Francisco, and that's since mid-2025. So it seems like even though there was so much excitement, especially around June for Tesla's robotaxis, it seems like they're behind the game compared to Google's Waymo. Yeah.
I mean, and the number of vehicles is actually pretty low too, right, compared to what Waymo's doing. Now Tesla says they're going to expand to Las Vegas. Nevada, and then also Phoenix. That's the next spots for them. And then people like Ives think that it's going to be 30 more markets by end of next year.
Wow.
I think that's overly optimistic because we haven't even heard of what the next markets are. They haven't even pulled a safety driver out of in Austin and San Francisco yet. So a lot of big ifs there, but of course that's sort of the big payoff if they actually do it.
Right, Wedbush's Dan Ives, always bullish on Tesla though. Pras, Subramanian, thank you so much for joining me in studio. Appreciate it. And coming up, we get a look at some of the top champagne picks out there ahead of New Year's Eve. Next up on Market Domination Overtime. We're coming up on New Year's Eve, the night when most of us may have at least one glass of bubbly, aka champagne. In fact, according to Wallet Hub, more than 360 million glasses of champagne or sparkling wine are consumed on New Year's Eve alone. So what can people expect when they go to grab a bottle at the store in the next couple of days? Joining me now is Allison Napies, Wine Spectator Senior Editor and Tasting Director. Allison, thanks for being here in studio to kick off the end of this year.
Yes.
Let's walk back though, because this has been a crazy year when it came to the spirits industry. Back in March, we saw that 200% tariff threat on European Union imports of wine and spirits. So where are we at now? How is this all settling out to end the year? Maybe not so much.
Yeah, it's a little bit of a sad end to the year. We do have a 15% tariff on European Union wines. Other numbers, other countries. And basically, it's tough. When the tariffs were announced, basically you had a lot of winery import companies and wineries that went together and said, okay, we're each going to take some of these costs. We're going to keep the prices from rising for consumers. But unfortunately, this is continuing, it looks like, through 2026, through the Trump administration, in which case costs are probably going to rise. It's only so much that the wineries and the importers can absorb.
So are the importers and the wineries no longer really sharing that cost, and that cost will go directly to the consumer now?
No, I think they will still try to share it, but as think about all the fixed costs that wineries have, there's only so much margin they can really eat into. And as an import company, you've got the dollar against the euro. Yeah. So there's a problem there. You've got inflation and just all of this economic uncertainty. And I think, they have to find some kind of fine line between both.
Now, we do have that Supreme Court decision about the legality of tariffs coming up. Should this stay in effect, can consumers expect maybe less diversity on the shelf?
Yeah.
What's 2026 going to look like at your local liquor store?
I think that what you'll definitely find is certainly at some point prices are probably going to go up if tariffs remain in effect. But as you said, I think diversity, this is kind of what I would extrapolate, is that some of these importers, retailers, restaurateurs are going to say, okay, I'm going with the tried and true names that I know I can sell, and maybe these kind of up and coming labels or like smaller new wineries that are a hand sell, I'm going to back off of those for now.
Now, on top of this headwind, they're also facing this lower consumption among Americans as well when it comes to wine, when it comes to spirits. So what do you make of that? How much are we down year over year in terms of just how much Americans are drinking these days?
Yeah, honestly, there's been a small to larger decline almost every year, basically for at least 20 years now. So add that all up, it's quite a bit. And looking at wine sales specifically for 2025, the projection is about 8% down, which is really significant. Putting that into perspective, what could it be? Inflation, certainly people are thinking about these affordable luxuries that they can maybe do without. And for some people, that's wine, not for me. And then you also can kind of put a generational spin on it. You have the baby boomers retiring. They're trimming their belts a little bit and looking at their budget as they move into that new phase. We also have, of course, Gen Z. They, as many reports have shown, that they have a lower overall income than previous generations in the same age range.
They're under very financial pressure. They're facing a housing market now. They're up against student loan repayments, and so that's affecting how much alcohol they're consuming as well.
Studies have shown that they're actually spending the same amount percentage-wise of their income on alcohol and consumption, but that income is just lower, and so the value is lower overall.
Wow, and are these consumers also going elsewhere as well? Are you noticing that maybe something else is taking market share?
Yes, I think, today they have many choices. So there's, of course, beer, there's spirits, there's seltzer, there's wine, but also no drinking, no alcohol, and cannabis products.
All right, so let's bring it back. New Year's Eve is on Wednesday. What are Americans expected to do? Are they expected to splurge a little bit, spend less?
I think that we don't have the hard data on it yet. My feeling is that probably people may be looking for some lower price alternatives or maybe doing a little bit less, but they're still going to enjoy their holiday.
Now, you did bring some wine and champagne with you. Where should Americans be looking in order to maybe save, and where can they splurge a little bit when it comes to champagne for tomorrow night?
Absolutely. Well, I would definitely recommend that they go to winespectator.com because we have over 400,000 wine reviews and a lot of advice from our editors and tasters, including these 4 bottles that I brought. So the first to look at our bubbles, of course, if you're somebody who thinks sparkling wine and you want champagne, you're probably going to start off at about $50 a bottle.
Okay.
But there's a lot of wine regions that make great sparkling wine for less than that. I selected an Argyle Brut Rosé from Willamette Valley, so from Oregon, $30 and 93 points.
That's a pretty good price point, right?
A lot of bang for your buck there, I think.
Yeah. Now, if you're thinking maybe not so much bubbly, maybe you're going to go to wine, what are you thinking there?
So I have 2 wines at Wine Spectator. We kind of want to give everyone different access points, but going back to those affordable luxuries, how about a 93-point Chardonnay for $25 from California? This is the Diatom Chardonnay. It's a great wine that was also number 18 on Wine Spectator's top 100 wines of the year for this year, 2025. So great backstory, good value, widely available. And then I also brought a red wine from Lissini. It's a Brunello di Montalcino 2020, $80.94.
So, and that's if you're willing to splurge a little bit?
Yeah, splurge a little bit, but this is a vintage that's kind of juicy and delicious right now. So you can open it tomorrow night, or you could hold on to it for 5 or 10 years.
Is 2020 the year we should be looking back on for a really good aged wine?
It is the current vintage for Brunello di Montalcino. It really depends on what region you're looking at. California Cabernet, for example, is 2023, 22s right now.
All right, Allison, I'm taking notes on that. Quickly, when you look out to 2026, what do you make of the industry moving forward? Will these headwinds continue? Will winemakers get any sort of relief here?
I think that we're expecting to see people kind of go into one of two camps. Either they're going to double down on value, or they're going to look at luxury and premium wine. And I think that really for everybody in the wine industry, the question is, Gen Z, how to give them products and talk to them about wine in a way that'll make them repeat buyers.
All right, so Gen Z, all eyes on them to try to get them back in the door here.
Yes.
Allison, thank you so much for joining us, and Happy New Year.
Great, thank you, Happy New Year.
Time now for What to Watch. Wednesday, December 31st. Stock markets are operating on normal trading hours on New Year's Eve before closing on Thursday for the New Year's Day holiday. Taking a look at the labor market, we'll be getting fresh jobs data on Wednesday with initial jobless claims. Now, economists are forecasting claims to come in at 220,000 for the week ending on December 27th. That would be a slight uptick from the previous week, signaling that more people are filing for unemployment benefits and a gradual slowing of the job market. But at 220,000, claims are still historically low. Moving over to housing, new mortgage rate data from Freddie Mac is coming out on Wednesday. The current rate on a 30-year fixed mortgage sits at 6.18%, and it has been hovering near multi-month lows. That's following 2 consecutive weeks of declines. Any further move down could help revive buyer demand, which has been quite sluggish in 2025. Investors will be watching closely to see if lower rates are translating into more activity or if affordability remains the biggest constraint going into 2026. And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3:30 p.m. Eastern for all your latest coverage leading up to and after the closing bell. Have a great evening and Happy New Year.